Good morning, everyone, and welcome to this new educational video, where I'll try to convey to you the concepts that form the foundation of my strategy. In the very first video, we carefully looked at precisely how to effectively follow the prevailing trend through observing higher highs and consistently higher lows, through analyzing momentum, and also how to accurately identify significant reversal patterns, which are comprehensively also covered in my detailed book. So, for example, distinct double tops, clear double bottoms, characteristic N-shaped patterns, and these specific reversal patterns we diligently look for, as well as various candlestick analysis patterns such as the powerful engulfing, the subtle harami, the strong hammer, the precarious hanging man, and the indecisive doji. In short, all those patterns that can signal the start of a reversal. Obviously, these patterns alone are not enough. I always, of course, look for them based on where these patterns form near the levels of my strings. You're all familiar with my levels that I extract with my algorithms, and now we're going to introduce them precisely to help everyone understand how it's possible to make the most of them by combining technical analysis and candlestick analysis. That is my approach, and of course by applying my strategy, which you can all learn about by purchasing the book that's available, just to remind everyone, on Amazon, both in paperback and Kindle versions. So let's introduce our levels. Basically, my strings are, they are strings that extract certain levels. So now I'm going to show them to you using the indicator that's part of the Pro service, which all of you can access by subscribing. It gives you access to a whole range of indicators that allow you to have my levels on any asset at any time you want, as well as other tools that we might present in upcoming videos. In this video, what I want to focus on is the string of levels. The string of levels consists of 17 levels. It starts from the central level, the pivot point, which is the HV level, the one you see here in gray on this chart, which is a real-time chart of the Nasdaq. Today is the 10th of July, 2025. In Italy, Naples, to be precise, it's 11 in the morning. And as we were saying, here it is, we can see the whole string. This is today's string of Nasdaq levels. This is basically the framework, the structure for today, where I expect the Nasdaq might move. Obviously, the string is built, of course, above the HV level, which is the pivot. We have the resistance levels starting from RD0, RD1, RD2. Then we have the VIX cluster with the expected maximum, and then we have which is the maximum expected value, where it usually accumulates before breaking out. And then we have basically the extreme range levels, the daily max and the daily mean, which more or less encompass the entire movement that we have hypothesized could occur during this day. The first approach with my levels is obviously to understand that we must always use the HV level as a reference point. So if we are below it, basically we have a tendency that could be downward. Obviously, this tendency is just that, a tendency, a mini trend, if we look at it on the 5-minute chart. And as I always say, in the range area, when we are in situations of low volatility, the first levels to refer to are RD1 and SD1 as far as the daily string is concerned. These levels usually manage to contain the price from the regular trading hours up to roughly the opening, and so in these situations we can work these range areas. You see, for example, today how many times in the area of SD1, which obviously represents the lower area of the run guide, gave opportunities for long entries that in the end would have paid off. Even this one, made at 6 in the morning, you could have taken home a few points every time it bounced. In the same way, the break of this level, for example, in this case, South Dakota 0, which is the first reference barrier and the first, let's say, mini range where you often stay when volatility remains particularly low, so the price stays anchored in this even narrower range. But as a primary reference, always use RD1 and SD1 with these two intermediate levels. You can see here how from the opening the market tried to make new highs compared to those recorded at the close, but it didn't succeed. It went below the HV level, tested it from below again, referring to the concepts of my strategy, which states that when a level is tested, we must always evaluate levels in relation to the current price. Price is above, it acts as support. If the price is below, obviously, the level acts as resistance. In this case, it broke through the AHV level right at the very beginning, then tried to retest the same level, couldn't get past it, and went on to test the lower level. Here it attempted a timid rebound, but it couldn't even manage to go up. Based on the concepts we discussed in the first video, in short, breaking the first high, so this already made us realize that the trend could continue downward, and in fact it did continue. It broke the SD0 level, then retested it from below, so this was a new opportunity to go short here in the SD1 area, even though here it didn't actually touch it, because we always have to remember that we're not chemists. So sometimes the level might be hit or sometimes missed by a few points, as probably happened in this case. The price still came back to test the resistance level, which in this case is SD0. It tried to break through, didn't succeed, and went back down again to retest the lower level. Bounce, new test, 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 and then it... All these times were obviously opportunities to make even small scalps, maybe 10 or 15 points at a time. Well, I didn't measure exactly, but even though it was early in the morning from 29.83, so 10 points at a time could be taken, or maybe some slightly bigger swings with rather tight stop losses. Then, of course, when the market took off and you found yourself in a position, but maybe if you had thought about exiting in the same way here, at the break of the previous high, which was this one, you can clearly see how it broke it, retested the previous high from above, the concepts we explained in the first video, a simple retracement, and then the market resumes its upward movement. So this was a good buy opportunity that could definitely have given as a first target the SDO level, which, as you can see, acted as resistance because it stopped the price. They tried to push it back up. The body of the candle, as you can see, stopped right above the level. It was only slightly breached by the wicks of the following candles, and from here the upward movement started. Everything exactly according to the strategy. Of course, not every day starts out this calmly with all the levels being tested. Other times we might find ourselves in situations where the market, right from the regular trading hours, from the opening of the regular trading hours, shoots up and we find ourselves above it. So we already know that the trend is clearly upward. For example, if today the market if it had continued this downward move and hadn't stopped at RSD1, and maybe if we had tried to go long from that level, we would have had to stop out because the market kept going. We would have realized we would have paid the price, the cost of our information to the market, which was telling us that the initial daily range had probably been broken and that the trend would likely be more downward. Then we could have looked for short entry opportunities when the SD1 level was tested from below, aiming for targets that could be SD1 or even lower areas, depending of course on the volatility at the time, the context, and the momentum. As we saw yesterday, momentum also plays its part, and here look at how momentum indicated that a breakout was coming, because this candle with this bounce broke out of this mini range that had formed below. So momentum also helps us with these readings. So even in this case, momentum helped us understand whether we were facing a continuation of the move or perhaps a moment of consolidation that could then lead to a reversal. In that case, we would still have obtained information from the market by taking that stop, because we might have waited for the next opportunity to go long again. Just because you take a stop on a long position doesn't necessarily mean you have to go short. Be clear about that, or vice versa. It simply means that the trade you made was wrong, and you need to acknowledge that in order to interpret this cost, we pay to the market in a positive way and get the right information for the next. It's in those moments that we need to stay clear-headed and have the ability not to let ourselves be overwhelmed by emotions, which will definitely push us to jump right back into the market to make up for the loss. But that's the wrong attitude to have, because it would surely lead to a revenge trade, which is neither thoughtful nor rational. Having made this brief digression also on this on a psychological aspect, by the way, there are other videos on YouTube where I've dedicated entire sessions to explaining many aspects of trading psychology, which you can obviously find on my YouTube channel. Let's move on. Obviously, when you have a clear and strong trend, you operate in that direction until the price, as I was saying, stays within these ranges. We can can go long at the lower end and short at the upper end, but the moment these ranges are broken, we obviously work in the direction of the trend of the breakout. You can certainly try, as I showed you, for example, yesterday, that you can also take a contrarian approach, but only at important levels, and by reading the momentum through the candlesticks, the size of the Japanese candlesticks, the volumes coming in, and we also have the support of the VLC indicator, which highlights by coloring the candles where the breakout occurs. For example, this is the breakout after touching yesterday's 1D high, and after a bit of sideways movement with doji candles, then the breakout of the doji. Here at the definitive breakout, the volumes come in and then give an additional push downward to the price from 23 times, basically earning about 80 points if you wanted to wait for all the possible confirmations in this case, okay? So this too was something you could read through the momentum, because the momentum here was telling us, okay, basically that this test was not a signal to go long again, because this momentum was telling us that right here in the area of the highs, there was a lot of indecision caused by all these dojis. The price basically remained anchored around the VIX R1 area, which is this first fuchsia line you see, and then there was a break of these dojis with candles that had bodies indicating bearish momentum. This momentum intensified, went to test the level, there was a dead cat bounce, and then you can see in the next opening that volumes came in and colored the candle, so it was definitely a valid breakout. Even at the opening of this candle, even if you then experienced the bounce from the next SD1 level, the market still went on to retest lower rises. So by reading the momentum and the candlestick patterns in this case, Japanese candlesticks that indicated indecision at the high, okay? There's this beautiful hanging man, or inverted hammer if you prefer, which is this nice yellow one here with volume after volumes, hadn't come in here, okay? There was a spike to test exactly 1D max with a beautiful breakout, and even this alone was a beautiful, even if you didn't want to set a pending order right at 1D max, this was definitely already a good entry point. Another one would have been this 23.048, which would have definitely paid off a lot, but even here, after this further confirmation, you could have easily entered, just like we saw the opposite happen in this move at the open with the break of SD1, which is this yellow line. You can see the volume coming in, indicating strong bullish momentum from here, 23.023 to 23.107, but if you wanted, you could have also stopped here at 23.080. That was 40 to 50 points to grab quickly. What I mean is, when I tell you to always try to take the comfortable part of the trade, is so we reduce risks and maximize the speed at which we bring profit home. We stress less and stay sharp because we don't waste too much energy staying in trades for too long. Obviously, the levels where we try contrarian trades, where I personally tend to try Themar, the VIX clusters, and 1D max. It depends on the volatility, as I've said, and on how we get there, but these are definitely the areas where I attempt them. Then it depends a bit on the day. There are also days when I try contrarian trades from RD1 or RD2, like for example, this could have been one of those days. Actually, this was more of a range trade than a contrarian one, but there are days when the market has been moving more to the downside, and then you get violent spikes at these levels. Those are the trades where I go contrarian, definitely with quick entries, and by quick I mean not with a pre-placed order, but rather if the price gets there quickly, I jump in on the spot. Of course, this means risking a bit of slippage, because that almost always happens, but that's the kind of trade I want to execute quickly, just to grab a handful of points and sometimes even catch a lot of intensity in the opposite direction. Sometimes even with contrarian trades, you can get moves of 80 points, for example, on the Nasdaq. So with particularly volatile moves, you can really get some great trades. This is just an introduction. I've given a bit of an overview of the concepts and what to consider when the price is approaching my levels. Today, in this video that I'm about to wrap up, we started with the daily ones, then we look at the weekly and monthly ones, and then maybe in the next guide video, we'll look together at the weekly and monthly ones and how to then combine the daily, weekly, and monthly levels so as to give you a broader overview. And of course, there will be more videos introducing other elements that are part of my strategy, I want to try to keep these videos, as I mentioned yesterday, around 20 minutes each, so that, well, they can be accessible to everyone at any time of the day. With this, we've reached the end of this second educational video about my strategy and its application using the levels. Thank you all for your attention, and see you in the next video.